Hi, this is Stuart Wemyss and welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. And a quick thank you to Campbell Wallace for completing the Q&A episode yesterday. Hopefully it's always good for you guys to listen to a different voice, a different perspective maybe, coming from as Campbell would constantly remind me, a different generation. Anyway, today I would like to talk about the best safe income style investments. Another way to put it would be a defensive investment, fixed income, fixed interest investment, whatever you want to call it. But, there's a lot written about the share market, and the share market's worth, the Australian share market is worth around about $2.9 trillion. Could be different on any given day, of course. But the bond market is worth more than half of that. So it's over $1.5 trillion in terms of bonds issued by federal governments, state governments, semi-government entities, as well as listed corporations. Of course, the banks are big issuers of bonds. But of course, there's not a lot written about the bond market and about bond investments. Also, there is a substantial amount of bond ETFs as well. And again, if you don't have a good understanding of that market, how do you choose which ETF is right and so forth? Well, that's what I want to go through today, and I'm going to share some examples of ETFs that we would recommend or we would use. Probably recommend's not the right word because, of course, everything in this podcast is always information. It's not advice, and we're not necessarily making a recommendation, but really just sharing, our approach to these sorts of things. And we don't want to be so benign, we don't want to be so scared of talking about particular ETFs because obviously that reduces the practicality of podcasts like this. So I'm not saying, if I talk about a particular ETF, I'm not saying you should put all your money into it, of course, but it's one of the ones that we would consider. So let's talk about defensive investments then, and when to use them or why you might want to use them at particular times during your investment cycle. So really the general definition of a fixed income investment or a defensive style investment is one that gives you a predictable level of income, because remember, income, it's not certain, but it can be more certain than, say, capital gains. So, and that's one of the things around the Australian market versus international market. One of the benefits of the Australian market is that if you look at the index, ASX 200 index, pays about a 4.5% yield, but then you get some imputation credits. So you gross that up. So a pre-tax return of maybe 5.5%, maybe a little bit more than that on any sort of given year. And you get to bank that return each year. So it does reduce your risk because you need less capital growth to justify that investment. Of course, it's not as tax effective if you get income because you've got to pay tax on it. But just from a perspective of we're looking at an investment, and if investment is paying a return each and every year, then we don't need much in terms of capital growth necessarily justify that investment. And so fixed income investments are very much like that. They provide most of their return in income. Hopefully that their capital value or market value is very stable and quite often less sensitive to market fluctuations and change in sentiment, economic downturns, these sorts of things. And as such, they're seen as sort of safer style investments. So there's probably really three common reasons why you might be drawn to a defensive style investment. The first one is that typically, or traditionally, I should say, a balanced portfolio does include a mix of both defensive and growth investments. And the idea behind introducing defensive investments into a portfolio is to reduce the portfolio's risk and also increase diversification. So it reduces risk just because it's less sensitive to these market changes. So, if the market drops 30%, hopefully your defensive investments have dropped far less than 30%, maybe even increased in value, and that sort of offsets, the performance. And that's why diversification is important as well, because if you're going to get negatively correlated asset classes, that helps. And there's a large body of evidence and data, I should say, that except for 2 years ago where there was the interest rate shock, when central banks were telling us they weren't going to raise interest rates and they decided to change their mind, apart from that event, and there's only been a couple others like it in the last 100 years, So except for those situations, bonds are negatively correlated with shares, which means that if shares have a bad year, bonds tend to have a good year. And so that negative correlation is good because if you're spreading your eggs across multiple baskets, in any one year, some of those baskets are going to win and some of those baskets are going to lose, but hopefully at a portfolio level, you get to spread your return. You get to even out your return at a portfolio level. So portfolio construction's one reason. Now, I just might put a little side note here that I've previously recorded an episode about, maybe younger people should be all in growth in terms of asset allocation. And so I acknowledge the portfolio construction methodology and, just the general approach there. But arguably, if you're just focused on maximizing long-term returns, then you wouldn't necessarily include fixed income investments because, as I said, they're lower risk investments, but with risk comes return as well. So they're going to be lower return investments. Okay, the next reason you might want to use defensive investments at times during your life is because you've got a short investment horizon. So, anyone that invests in the share market should expect a negative return year one in every 4 years. So it's not that uncommon to have a bad year, let's call it. And the share market will typically drop by 30% or more every sort of 7 to 10 years. It can happen more often than that, but just as an average. And it can take typically anywhere from 6 months to 4 years for that to recover from such large declines. So therefore, if you've got a investment horizon of less than 10 years, then you really don't have the time to sort of ride out those market fluctuations. And it's possible that, if you've got a time horizon of, say, 4 or 5 years, it's possible you'll lose money over that time just because you can't ride that market out. And, it doesn't make sense then to expose that money to that risk. And lastly, it could be due to low risk tolerance. And that's more common, I should say, for people that are either retired and have surplus assets or are getting very close to their end of their life. If they're getting very close to the end of life, they've got no capacity or desire to experience volatility. They want their investments to be safe. They want the value of their investments not to change. And in that situation, capital preservation becomes more important than capital returns. Similarly, and I've got a couple of clients like this, they might be retired and they know they've got more than enough money than they'll ever need. And so they just don't want to take the risk because it's not going to change their life. And again, they value investment stability. So in that situation, they might have a reasonable proportion of their overall assets invested in defensive investments. Okay, so if you're looking for a defensive investment, what are your best options? Well, I'm going to talk about sort of 4 broad options today, and I'm going to sort of take you through each of these. One of those broad options is to invest in ETFs, and that's where I'll probably spend most of my time. But the first one to really talk about is mortgage offset accounts. And the way we would look at mortgage offset accounts from an asset allocation perspective is that we have property and we have debt. And then obviously the market value of that property less the debt is our equity in our property, the value of our equity in our property. And that's really what's contributing to hopefully making a contribution to funding retirement. The cash in offset account we would look at as a defensive style investment. So we wouldn't necessarily just theoretically go, okay, well, net debt is lower. So mortgage balance less mortgage offset account is net debt. And so we've got more equity in the property. And we could look at it like that conceptually. But from our perspective, we look at it as a defensive investment because it's very liquid. It's going to earn a return in terms of the interest saving that a mortgage offset account provides. And we've got ready access to it. So it ticks all the boxes in terms of a defensive style investment. And so if you have a mortgage and therefore you can attach a offset account to that mortgage, that's typically the best place to accumulate cash and to get exposure to these sorts of defensive style investments. And the reason for that is that the return is guaranteed. So there's no risk associated with the investment. And from an after-tax perspective, the return is comparatively high, probably the best return you're going to get into the market. So firstly, if that offset account is attached to a loan that is not tax deductible, and let's say in today's interest rates, you're paying maybe 5.6% on a home loan at the moment, well, you need to earn a return of, say, 8% or more pre-tax, because obviously if you go and earn interest, you're going to pay tax on that interest, to be better off? Well, there's no zero risk investment that I know about that's going to pay you 8% at call in terms of an interest rate. Now, if it is a investment loan, well, investment loan interest rates are north of 6%. Still, if we overlay the fact that it's risk-free, and the reason I say it's risk-free is you are guaranteed to earn a return every day that money is in that offset account, because you are guaranteed that the bank's going to charge you interest on the loan. So therefore, if you've got money in the offset account, your return is equal to the interest rate. And there's no question about that. There's zero risk. And so again, even if it's an investment loan, you're paying circa 6% today in terms of interest rates, it's still the best risk-free return that you've got ready access to that is available in the market. So if you do have loans, attach an offset account. That's really the best place to park funds or to build a defensive part of your portfolio. So the second option is term deposits. I'm not going to spend too much time talking about these because I think there's better options than term deposits, but everyone would be familiar with a term deposit, right? You commit to a certain maturity, that money is locked away. Typically, if that term deposit is provided by an ADI, an authorised deposit taking institution, it benefits from the $250,000 government guarantee. So there's zero risk really associated with a term deposit. You've got to leave it in there for the term of that deposit. And if you break it before it matures, you typically pay a pretty hefty penalty, like it's not worth really breaking it. It just means you've got to lock your money away for longer periods of time. And at the moment, in a downward interest rate cycle, you're not really rewarded for locking your money away for longer periods of time, because obviously the market expects interest rates to come down over the next year or so. So at the moment, the best sort of terms are sort of 4 to 7 months. But in a normal interest rate cycle, sometimes you are rewarded for, a 2 or 3 or 5 year term deposit rate. But again, you are locking your money away and you're not going to have as much flexibility. Normally, term deposits pay, interest monthly or quarterly, depending on their structure and so forth. And they used to be used a lot. I think the emergence of ETFs and better ETF style investments now give retail investors, just general Australians, greater access to better options. And I think we haven't used term deposits in our business for more than sort of 10 or maybe even 15 years. So I think an inferior option there. Okay, the third option is a fixed income ETF. So that's really an ETF that invests in bonds. And as I said, the bond market in Australia is worth over $1.5 trillion. So it's a huge market and one that most investors don't really know much about. But a bond is very similar to a term deposit, if you like. Bonds can be issued and are mostly issued with a fixed duration. So they could be very long dated bonds, 20 years. Or they could be much shorter dated bonds, maybe 5 years. Some bonds don't have a maturity. They're sort of evergreen bonds, but they're less common. They pay an interest, and a bond typically pays an interest between 1 to 4 times a year, so either quarterly or annually, sometimes biannually. And that interest rate is called a coupon rate, just a different term there. A bond can have either a fixed or floating rate, so they don't call it variable, it's floating in terms of the terminology. And the bond value can be impacted by a number of different things, like time to maturity can have an impact. So that's really what we call in the bond market duration, and that's duration risk. If you've got a very long dated bond, you're very much exposed to the vagaries of how interest rates will change over time. The strength of the issuer of the bond. So, if it's the Australian federal government that's AAA rated, you've got no risk. It's very strong. But if it's issued by a corporate that's just about to go bankrupt, that's a problem, and that's going to impact the value of the bond, of course. The bond's rating. So rating agencies, particularly if it's investment grade, will rate a bond, and I'll talk about that in a second, that'll give you a sense of, how much risk there is and expectations around interest rates and inflation. So again, if you have a bond that is fixed for 5 years and interest rate expectations change or inflation expectations change, that could have a large impact on the value of that bond. Because, for example, if I've issued a bond for 5 years and paying 3%, and then The expectations are that interest rates are going to rise substantially very quickly over that 3-year period. Then my bond starts to look, very unattractive, and that will be reflected in its market value. And so bonds have a face value, normally $100, and the market value can trade at a discount to that face value or even a premium sometimes to that face value. Now, if you hold the bond till maturity, you always get your $100 back. So it's possible you can buy a bond at discount, hold it through to maturity, and you'll get your money back. And that's what they call yield to maturity. That's a percentage rate in return. As I said, there's about 3 main rating agencies: Standard & Poor's, so S&P, Moody's and Fitch are both rate bonds. Sometimes bonds are rated by all 3 of those rating agencies, and sometimes only by one. And we would normally only invest in what's called investment grade bonds, which is really anything with a triple B minus rating and above. And essentially it means that the probability of default for an investment grade bond is usually below 1%. So they're pretty safe investments. Now, you can get non-investment grade bonds, often referred to as sort of junk bonds, and some of those can be still relatively low risk, or the bond issuance might be so small that it's not worth paying a rating agencies for a rating. But also, those junk bonds could be terrible quality in terms of the probability of default is very high. So we typically steer clear of anything that's not investment grade rated and really stick to the safer sort of stuff. Okay, so what I've done is I've split the bond market up into sort of 4 sectors, if you like, 4 categories, and those categories align to ETFs as well. So the 4 types are really government bonds, corporate bonds, composite ETFs, and then hybrid securities. And I'd like to talk about each of those 4 different categories in turn. And what I'll do is I'll share some of the ETFs that you could consider that are going to give you exposure. And then I'll sort of wrap it up and then talk about, well, what would I look to just as an overall for fixed interest or bond ETFs. Okay, so let's talk about government bonds. Now, government bonds, particularly in Australia, very, very safe. Of course, the federal government has a AAA rating. The states have, still a AA rating or above. Victoria, might be sort of skirting on maybe a lower rating potentially coming up. Who really knows? But it can be issued by the federal government, state governments, or what they call semi-government entities, but essentially are really backed by the government. They're very highly rated, which means that they're very safe, which means they typically pay lower income yields. But the capital value of the bond tends to be pretty safe, especially if it's a floating rate, because a floating rate obviously can move in line with interest rate and inflationary expectations a little bit better than what fixed rate bonds can do. So it's not to say that they're perfect, though. I mean, if you look back in 2022 when we had that interest rate shock, when I mentioned earlier when the central banks decided to hike interest rates, actually during that time, Australian government bonds dropped around 10%. So capital's not perfectly safe like a term deposit or an offset account, but these events are very, very rare. And if you have a look at government bond ETFs like BHYB, which is a Vanguard ETF, you can expect an income yield at the moment around sort of 2.8 to 3%, so about 1% below the RBA cash rate. There's options to invest in global government bonds, such as VIF, but again, the yields tend to be lower than Australian yields. And also, as an investor in fixed interest, you want to think about foreign exchange. And so I think if we're looking for defensive style investments, we want to reduce as much risk as possible, and so reduce that sort of foreign exchange risk. So if I wanted something super, super safe, and I'm happy to take a bit of a haircut on the yield, then government bonds, VGB, would be a good way to go. So let's talk about corporate bonds then, which is the second category. And these are bonds issued by sort of major corporations. And so if it's an investment grade rated bond, it's going to be a pretty sizable business to issue that bond because it costs money to get the rating. Typically, they're going to be banks and financial institutions. So insurance companies, the big 4 banks are major issuers. I should say big 5, including Macquarie there. The infrastructure businesses in Australia and just large corporations like Telstra, Goodman Group, these sorts of issuers. Those corporate bonds can fluctuate more in terms of value depending on economic environment and also the strength of the issuer, so the company that issued them. If we look at current yields at the moment, so a BetaShares ETF CRED, CRED, is a long duration investment grade Australian corporate bond fund, and it's yielding about 5.1 to 5.3%. So for anyone listening to this in the future, it's 1.35% above the RBA cash rate. So you can see you're getting about sort of almost 2.5% more than what government bonds will pay you. Another option to CRED is HCRD, which is an interest rate hedged version of CRED. So it's designed to sort of protect investors from changes in interest rates or inflation expectations that they have on bond values. I think that's probably a little bit better. Slightly lower yield, slightly just under 5%, but paying for the interest rate hedge to take that risk out of that fund. There are other options to invest entirely in Tier 2 bank bonds. Now, remember, we've got some of the safest banks, some of the biggest and safest banks in the world in Australia. And so, normally if you said, let's buy a bond fund that's just invested in bank bonds, just in the financials industry, you would look at that as an inferior investment because it doesn't have the diversification that a wide corporate bond fund will have that's got exposure to many different industries. But there's a couple of ETFs, Sub-D, SUBD, or B-Sub, BSUB. So it's a Van Eck or a BetaShares ETF there. And they invest in the Tier 2 bonds that are issued by, mainly Tier 2 bonds issued by the big banks in Australia. And it's a better yield than CRED, which is the corporate bond fund I just mentioned, 5.6, 5.7%. But again, doesn't have that diversification. It's all in Australian financials. You might look at that as a positive, or you might look at it as a negative. It's certainly up to you. Now, there are global corporate bond funds, but they tend to be inferior in terms of yield. And the only way you're going to get better global yields is if you go emerging markets or non-investment grade, what they call very high yield bonds. But I would say stick away from those. They're going to be inferior. So it's really Sub-D or B-Sub versus CRED or something like that in the Australian market. And you're looking at sort of 5 to 5.5% in terms of return there. And the good thing with these ETFs is they pay the income monthly. So it is going to give you a nice predictable income stream over the course of the year. Third category is what's called composite ETFs. And really these ETFs provide a mixture of government bonds and corporate bonds, and they manage that asset allocation. So there's one, OZBD is a pretty good composite fund, and it's paying a yield of about 4%. So it's really about the RBA cash rate, equal to that. Again, I think those corporate bond ETFs that I just spoke about are pretty low risk. I'd say very low risk. And I think that's where I'd be sitting as opposed to composite or government bond ETFs. And the fourth and final category in this ETF option is what's called hybrid securities. Now, hybrid securities combine features of both shares and bonds. So they pay a regular coupon. Their coupon actually has franking credits attached. So normally a bond is just interest income. With a hybrid, it's got some franking credits attached. So it's more like a dividend. And so particularly for low-income taxpayers like a self-managed super fund or an individual that doesn't have a lot of other taxable income, its grossed up income can be quite attractive because you got the imputation credits. Hybrids can automatically convert to shares, and it's typically triggered. So for bank hybrids in Australia, it's typically triggered if they don't meet their capital adequacy ratios. So anyone that follows the financial press pretty closely might remember back in March 23, Credit Suisse went bust, and there was a bunch of hybrid security holders with Credit Suisse. And in fact, they got completely wiped out. So bondholders got paid. Equity holders actually ended up receiving some money, but hybrid holders got completely wiped out. They lost their investment. Now, their structure's a little bit different to what happens in Australia. And again, the banks in Australia are some of the strongest, and they're in a very, very strong capital position. So the chances of that happening, it's not impossible, of course, but the chances of that happening in Australia are very, very low. However, what happened a couple of years ago is that ASIC tightened the rules around issuing hybrids. And the problem is that they were issuing hybrids to, a lot of retail investors, mum and dad investors that didn't really understand the investment. Each hybrid issue is very different and it needs to be valued and looked upon very differently, because what you need to do is work out what is the probability of conversion, and therefore then you can work out what you want to pay for that security. Anyway, they tightened the rules, which essentially means they killed the hybrid market. There's probably not going to be too many new hybrids that are issued. That means there's only about 18 listed hybrid securities issued by the banks that are left, with about sort of an average period of 6 years left to run. So these things will disappear in the next 6 years, but for now they're okay. And there's an ETF that follows the bank hybrids, BHYB, which is a beta shares ETF, and it's paying a grossed up yield of 6.7%, which is about 1% better than corporate bonds. So I think it's a really great place to put money. Hybrids can have more capital volatility. So if we have a look at what happened to hybrids in 2020 when COVID hit, they dropped about 10%, and they took about sort of 3 to 4 months to recover that drop. You normally, in any particular year, you might see some volatility of 1 to 2%. Normally closer to 1%. And that can go in both directions, by the way. So you can see some appreciation, capital value, or depreciation. So over the course of the year, even if you lose a little bit of capital, you're still going to make it up on the income side. And the longer you invest in hybrids, the greater the probability that all sort of smooths out. Now, anyone that's been listening to this podcast for any period of time knows I employ a evidence-based, rules-based approach to investing, which typically can be described as investing in low-cost, very well-diversified index funds. And the reason for that is, over the longer term, 90 to 95% of equity managers fail to beat their index. Well, active bond managers do slightly better than that. Over the past 10 to 15 years, it's about 68 to 82% of bond managers fail to outperform their index, somewhere between, say, 70 and 80% if we're going to round off those numbers. So it's not impossible to find an active manager in the bond space, but the problem is bond returns are going to be much lower. Long-term bond returns are going to be, maybe around 5 to 6% at best. So fees and minimizing fees become even more important in the bond market, because you certainly don't want to pay 1% in terms of fees, because that could potentially be a large proportion of your overall return. And so if there's only 70 to 80% chance, well, actually, if there's a 70, 80% chance they aren't going to beat the index, then I think sticking to index style bond ETFs is the best way to go. Okay, and the fourth option I want to talk about. So remember, I talked about option 1 is offset account. Option 2 is term deposits. Don't like them. Option 3 is ETFs, and we're sort of spoke there about highlighting really corporate bond ETFs or hybrid security, the hybrid security ETF. And the fourth option is what I've called alternatives. And there's a few different options that I would sort of put into that category. So one could be listed or unlisted mortgage funds. So really La Trobe Financial is the biggest player in Australia in the unlisted space. And what you'll find is these mortgage funds, what they do is they raise money and they go and lend it to people. It could be mezzanine finance, it could be property developers, it could be people that can't lend traditionally from the banks. And the benefit of having a mortgage fund is you've got diversification. So, you might have literally thousands or even hundreds of thousands of different loans in that fund, and you might get a couple of those loans go bad. It's not really going to move the dial very much in terms of overall returns. The challenge with these unlisted funds is they can have liquidity issues. So certainly during the GFC, almost all those funds were frozen, so you couldn't get your money out. The other thing is they lack a lot of transparency. You don't really know what risk you're taking. So sure, they advertise returns and they say, oh, we're going to be better than a term deposit, maybe 2% better or whatever. And on the face of it, it looks like a pretty good return, but you can't really assess return if you can't assess risk. And that's my problem, is how am I going to assess that risk? So once you overlay risk, I think I'd rather invest in a bank hybrid security ETF, for example, get 6.7%, rather than take a lot more risk and get maybe 7.5%, for instance. Private credit has also gained a lot of popularity over the last few years, and we'll start seeing some private credit ETFs, no doubt, over the next probably year or so. Private credit, again, it's about lending to corporations that might not be able to go to the bank or want to go to a bank for finance. I've got similar problems with that: higher fees, active management, lack of transparency, those sorts of things. And I've spoken about non-investment grade bonds or emerging market bonds, high yield bonds, these sorts of things. Again, if we're after a defensive investment, what we're really after is something that is going to give us an income. The income's not going to shoot the lights out, but at least it's going to be something. But we've got a safe investment, that our capital value is actually safe. So to my mind, I can do that and earn 5.5% to 6.5% at the moment, which is, I think, a pretty good return for a very low risk investment. Why would I want to take higher risk with any of these alternatives? So really, in summary, if we're looking for a defensive investment, a mortgage offset account is the best you're going to get. If you don't have any mortgages, good on you, then you're probably really looking to corporate bond ETFs or hybrid security ETFs that are linked to the banks. So hopefully that gives you a little bit of a better understanding of what are defensive investments and when to use them in a portfolio. And then if you do need to use them, which are the best options. I'm just conscious of time. I've gone a little bit over today, but so I can't get into any questions. But until next week, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.